We do want to take a look at the state of the U.S. economy, inflation, and much more with our guest, David Rubenstein. He is the Carlyle Group's co-founder and co-chairman. He's also the team owner for the Baltimore Orioles, and baseball season is here. We are getting ready to go.
Right, opening week.
I noticed your tie. You're with the Orioles tie straight out of the gate here.
Yes, I went to see a game yesterday. Unfortunately, it was rained out in Washington, but hopefully the weather will be better. We're opening in Toronto later this week, and then we come to Baltimore next week for opening day.
We're going to talk more baseball in just a little bit, but why don't we start with the economy first? Where do you think things stand at this point? Just questions about the economy, how things are going, questions about business confidence, consumer confidence. What are you saying?
I think the economy is in reasonable shape. I think the economy that President Trump inherited was in reasonably good shape. But I think the tariffs have scared some people and slowed economic activity a little bit. But I don't think it's going to push us into a recession. I don't think anybody's really projecting a recession in the near term. Right now, I think the tariffs have done a pretty good job of getting people's attention around the world, getting people's attention in the business community. As a negotiating technique, I think it's probably pretty effective. Whether you implement them across the board, all kinds of tariffs everywhere, that might be more complicated to do and might have some inflationary impact.
Do you think any of it was, well, speaking of inflationary impact, you don't think any of the economy that he inherited was juiced by, $2 trillion deficits when we didn't need deficits, and 24% of government spending when we didn't need to do that either. That's why the economy's rocking and rolling.
Because of COVID, President Trump and President Biden injected $5 trillion into the economy without corresponding tax increases. So both presidents and everybody along their administration wanted to do that because they were worried about the economy.
The criticism is for what happened after you didn't need any more stimulus, which brought in the 40-year highs in inflation. That's the criticism, that they went way too long.
I know a lot about inflation because I worked in the Carter White House, and so I know what inflation is, and it wasn't quite as high as we had in the Carter White House. But inflation was high, but it did come down. I think the Fed and the Secretary of Treasury said it was transitory, and in the end they probably regret that. But inflation did come down, and when President Trump got into office, inflation was probably around 2.8% or so, not so bad.
You think the Fed right now is more concerned about inflation, not going back to its 2% target, or more concerned about the economy slowing down and needing to step in to do something?
Well, those are the dual goals. Originally, inflation and the currency was what the Fed was supposed to worry about. We changed that a number of years ago, and they're supposed to also worry about unemployment and the general economy. I think the Fed is worried about the economy slowing down for sure, but I don't think they see a recession. I think they think inflation is coming down a bit. I think they're probably worried about whether tariffs will have, if implemented, a big inflationary impact. But I don't think all the tariffs are likely to be implemented, and therefore, right now, I think we're likely to have around 2% economic growth this year. 1.7 to 2% was probably what people project, which isn't terrible, not great, but an economy of $30 trillion, that's not so bad.
Wouldn't you need, we put a tariff on, matched by somebody else, we raise that, because it's a second derivative. Just a one-time tariff doesn't increase inflation. It increases prices, but it doesn't increase the rate of price increases every year, right? Unless it's a trade war, I guess.
But remember, tariffs are paid by the American consumers. They aren't paid by the person who importing products. And that's what people have to know. So when you have tariffs, you're going to have some inflationary impact. But what President
Higher prices. But not necessarily higher inflation. That was my point.
Higher prices will usually lead to, but it also slows down economic growth. What we learned from the 1930s is a massive tariff program, as we had in the 1930s, doesn't usually work, and that program was a disaster. So massive tariffs across the board, probably not a good idea. Talking about tariffs and maybe threatening them to get certain things out of other governments before you actually impose the tariffs, that might have a beneficial impact.
Yeah, you said that's a good negotiating tool. Maybe we do get a better deal from some other countries where we feel like we've gotten ripped off over time. What's the impact you see at your businesses, at Carlyle? Are they doing things to bring in additional products? Are they slowing their CapEx plans or their hiring plans as a result of any of this?
Carlyle has companies which have roughly 1 million employees, and a large part of them are in the United States. We haven't seen any deleterious impact yet from the tariff discussions, but at some point it could happen if we go into a big tariff program. I think right now what people are worried about is artificial intelligence and figuring out how to take advantage of artificial intelligence. And really, a lot of people are worried about people stopping to spend money on artificial intelligence. Many of the biggest companies in this country are spending a lot of money on artificial intelligence, which will help our economy. If they stop spending that money, that will slow down the economy.
Are Carlyle companies spending money on AI too? Because that's been the question. If this growth in spending slows down from the big companies,
right,
do other companies step up?
If they're not spending time on artificial intelligence, they're not doing the right thing. Everybody has to do something.
Time and money?
It's time and money, yes. Right now, NVIDIA's biggest customers are spending staggering amounts of money for artificial intelligence. That's where NVIDIA is getting most of its products from, or sales from, its big 5 customers. So I think it's a very important part of the economy. I wouldn't have predicted it 5 years ago. And I think NVIDIA is a leader in this, and I don't think it's going to change anytime soon. They've got a big head start, and I think they're in pretty good shape.
We've talked about how M&A activity is down
right,
in this quarter, maybe surprisingly so. But are there deals in the pipelines, or is there a lot of things that are kind of percolating up?
I think when the Trump administration was elected, people thought there would be a much easier FTC and Justice Department policy. It hasn't yet come to fruition. It might. So some people are waiting to see what the policies will be. We're also trying to, I think a lot of people are waiting to see whether prices come down for acquisitions. As you know, for a long time, there was a big gap between what buyers and sellers would pay. Now I think the gap is closed a bit, but it's not quite as close as probably we would like it to be.
Gap is closed because the market has come down, the equities market, and that's a reason.
The equities market has come down, and also people can see where the inflation is not going to be as big a problem as people once thought. But I think right now there's a pressure on a lot of the people in the private equity world to sell companies they've had for longer periods than they want.
Right.
And I think they will probably take a lower price. For a while, many people were afraid that if they were going to buy something, they might be buying it into a recession. They thought a recession might happen. Now they don't see a recession in the near term. So I think buyers are probably more likely to show up now. And sellers are adjusting their prices to say, I don't need a 30% rate of return for my deal. Give me a 25% rate of return. I'll take it.